Welcome back, fellow dividend growth investors and value investors. Before we get started, look at this. This week, earnings are coming up. I am really looking forward, and I can tell you, I'm not going to sleep well at night. But actually, this video is not about not sleeping well at night, but sleeping well at night, because the news is killing us over the last week. I believe that many people are currently getting afraid of a stock market crash. So one of the things you might be wondering right now is whether dollar cost averaging this month is really the right strategy, and maybe just wait for the stock market to crash and to go down. So I believe this is not a good strategy as a dividend growth investor. I really believe that dollar cost average at any time is the best thing to do. If you are like me, then we shouldn't get scared of the current news. The fact that the Dow plunged more than 900 points and it had the worst day since 2020 shouldn't matter. Because, for instance, look at it here. It's still around all-time highs. But on the other hand, if you go back to the 2020 pandemic crash, yes, it can crash 33%. But you know what? It didn't do shit to my dividend growth portfolio. I continued to collect dividends. There were maybe two stocks that cut their dividend at the time, and that was Shell and Disney. But the rest of the stocks actually increased my overall dividend income and projected annual dividend income still during 2020. So why would I be afraid? Because if you select good companies, it really shouldn't matter that much if you do your homework. And if you think about it from a price point of view that we're looking at right now, because it's a price chart, it only matters at the moment in time you buy the company. After that, you effectively, if you want to hold it for 10 years, you don't need to look at the price anymore. What you really need to look at is, are the fundamentals growing with the annual reports, and is the dividend growing? That's our main concern as a dividend growth investor, because weak fundamentals are usually putting the dividend at risk. Otherwise, we can just sleep well at night. But this was just from the Dow Jones stock chart point of view. There are more things that might make you scared, because if you go to Twitter, you see this post that, the bond market lost 6 trillion over the last few weeks or since the start of the year. Well, yeah, that's a shitload of money, I can tell you that. And if we then look at the US bonds, interest rates, Powell is suggesting 50 basis points in hiking the interest rate in May. Treasury yield is already at 3%. These are percentages we haven't seen for many, many, many years. And it reminds me really, actually, 2006 to 2007, when you could still get like a 4% return on your savings account. But then, what for me is really important always to look at is the Shiller PA ratio. It's standing now still at 33. It just generally tells me that, yeah, we might be scared actually for a stock market crash if you're invested in growth stocks, as an example, or in highly valued stocks. Because historical point of view, this is really still overvalued. Last but not least, what I also want to show you is that many companies fall in love with buybacks and providing shareholders with a yield in return on buybacks. HP Inc. is, for instance, an example of that. I'm bullish on that one, but that's for another reason. But what I can tell you is that dividends are the most safe during a crisis, as we can see from a shareholder capital return point of view, because in 2007, buybacks went to nearly zero in 2009. And I remember this quarter really well. Although I was not investing yet, I was watching a documentary on the news at that time that in Norway, there were no ships coming into the harbor. There was just no trade happening. For me, in hindsight, that was the bell at the bottom of the stock market that was ringing. The same I had with the pandemic in 2020, when literally in my neighborhood, no cars were driving for the full hour. It was just dead quiet. That was also the bottom of the stock market. I don't know which bell will be ringing next time, but what I can tell you is that buybacks again will be one of the first that will suffer, and dividends will be relatively safe. So what does this tell me? Dividend growth investing is probably, if you want to sleep well at night and if you are interested in cash flow generating assets, one of the best strategies to consider. But price is what you pay, what Buffett says, and value is what you get. And there are still really good dividend growth stocks that are heavily overvalued at the moment. And one big example of that is, for me, Nike. Because Nike has one of the safest dividends in the world, from my point of view, at a safety score of 97. It just hits all the numbers for me. Look at the balance sheet, really strong, AA- credit rating. So for a consumer discretionary sector company, this is really good. A debt to equity actually also quite good, 63%, and an interest coverage of 26. This tells you that based on the interest expense on the profit that is generating every quarter, every year, it can cover that interest 26 times. Think about your mortgage rate as an example, and then think about your salary and what the coverage is. Probably that's like 4 or 5 when you just bought a house. For Nike, this is 26, and I believe this is really important to consider, that this provides a lot of optionality, let's say, to do things here during a crisis. At the same time, it has been growing their dividends for 20 years already, at a dividend growth track record for the last 5 years compounded of 14%. But you know, this stock, well, you will quickly see here, it's just overvalued at the moment. It's one of those stocks that I don't own, but I would love to own. It's one of my dreams to be able to buy this company and buy stocks in this company. But you see it here. Everything is green except the valuation multiples. But you know, we saw on ASML that a multiple of 40 is actually not so bad. If you think that the growth of the cash flow is really justified. What we can see here is that the 5-year free cash flow growth is 24%, while the EPS growth is 12%. I believe that the growth number there for around 15% is actually more valid, because I know that this was of a really low basis because they missed 1 year. So if you take 15% for the first 5 years and then 8% thereafter at a discount rate of 10% and the terminal multiple of 18, you're talking really about $78 or something like that. If you are more bullish than me and you think like, okay, European DGI, you drank the poison cup, you're way too conservative. Now, okay, let's take 18% and 10%, which is quite a difference. And also a multiple of 20, we're still talking about $100. And I believe $100 is not so unlikely because, you know, it's a cyclical company. If there's a big recession, it will drop in price because the fundamentals will worsen. We have seen that also in the pandemic, where we can see here that the net income dropped to $2.5 billion. This was simply because, you know, people had less money in the beginning to spend. Of course, they recovered quickly because then the stimulus came and everyone started buying Nike shoes and such. But generally, I hope that during a next stock crash that I can load up the truck on Nike. But for now, it's too overvalued. And this is what I mean, at a yield of 1%, this would not let me sleep well at night because I would be overpaying for this company. Having said that, before I show you 3 attractively valued companies right now, if you like this kind of content and no bullshit, then please subscribe to my channel. And of course, if you are already subscribed, don't hesitate to give it a like, it helps the algorithm. What I would really love the most is just some comments, whether it's positive, negative, feedback. I'm all open for it. I learn the most, not only from doing my homework and sharing it with you and making this public so that I can hold myself accountable, but even more when you can hold me accountable. But also I learn a lot from the added insights that I often get from you in the comment sections. Okay, having said that, let's look into 3 dividend growth stocks that I believe are currently fairly valued or even at times undervalued. The first stock that I believe that will allow you to sleep well at night is Texas Instruments. Texas Instruments has a very safe dividend, as you can see. Maybe a little bit less safe than Nike based on my dashboard here. But still, you know, look at the credit rating. Debt to equity is below 60. This is one of my criteria to judge whether it has a strong balance sheet. But even more important, it has a 50 interest coverage. Again, it can pay 50 times their interest based on the profits it's currently generating. So from that point of view, their debt is not an issue during a crisis. If they would halve their income, we would still be talking about a 25% interest coverage. At the same time, we would also be talking about, you know, a stretched EPS payout ratio at the time, because it would probably go to 100, but we haven't been even talking about the company cutting costs during such a moment. And I believe with the commitment to their dividend, they will be definitely able to still continue to pay dividends. But actually, I believe that their growth prospects are really strong because we're talking about the semiconductor industry. Everything shifted to digital. Everything needs chips. And, you know, Texas Instruments is really big in these analog chips. And you need them in a lot of simple devices. And I believe that this company, therefore, is really there to stay and will continue to really reward us as shareholders. And also from a valuation point of view, this company is actually quite fairly valued at the moment, because the key statistics here might suggest that it's on the pricey end, because everything above 20 becomes light red and you see the cash flow even more. But if you look at it generally, everything is on green here, which means that it ticks all the boxes. And I believe actually that a price to earnings of 20 might be justified right now. So if I do my fair value calculation based on the future cash flows this company should be able to earn, based on a 6.5 billion baseline, if we look at it with a 10% for growth rate for the next 5 years, which I think is actually quite possible and probably even pessimistic if we look at the current state of the semiconductor industry. And if we then take into consideration 6% for the 5 years thereafter at a 10% discount rate and a terminal multiple of 17, we're still talking about $164 here. All in all, I believe that on average it should be valued at $167, which means like it's 3 or 4% overvalued. But you know, this is what I mean here with sleep well at night. This is what this company, in my opinion, allows you to do. If you want to hold this company for the next 10, 20 years, it really doesn't matter if you buy it at 166 or 173. The English have this saying of being penny wise, pound foolish. That's how I look at it when thinking about Texas Instruments. I bought a position actually at 167 back in February just because I put a buy order at that price. And I'm considering to buy some more in May with my next monthly payments that are coming up. So this is about Texas Instruments, but there are still other two stocks that I want to talk about from different sectors. And the second one that I believe is currently fairly valued or even a bit undervalued is an insurance stock, and that's Allianz. So Allianz here is a German insurance company, and its dividend is just qualified as a safe dividend. Now, why just 61 and not more? Well, actually, it should have been in the high 70s, but the last year growth numbers didn't look so well, and that had to do with the Alpha Fund issues that they have, where they had to do some litigation. It depressed their earnings a little bit. That's why not. Otherwise, it would have been in the high 70s. Still not a very safe dividend, but just safe. And if you look at it, credit rating AA3, this is really good, specifically also for European companies. A debt to equity of 40 and an interest coverage rate of 9.2. Again, they can easily serve their debt. Now, the growth prospects are neutral for me. I believe it's a slow compounder, slow growing company. It will not suddenly grow 20%. Don't expect this from this company. The insurance sector is also being challenged a little bit by fintech and such, but I don't see that really happening quickly. But what is also here, what you need to know is in 2007, 2008, it had to cut their dividend. It was in the middle of the blast zone at the time. It was not well positioned. It didn't have the same metrics as it has today. It's way better position right now. So it's not the same company anymore. And it has proven that because during the pandemic, there was a lot of pressure to not pay out dividends by insurance companies, but they were able to at least keep their dividend flat to satisfy the regulators. So this is important to know, and this showed me that the company is committed to the dividend. Well, currently it's trading at a price of €219. And if you look at the key statistics, almost everything is on green, except for what I just mentioned, the EPS growth. And also what you need to know is that their return on equity, therefore, because it had less income, was hardly outpacing the cost of capital. And this, for me, an important value creation metric. I believe this will improve going forward, and I see this as a one-off. That's why I'm closing one eye to this metric. And you can see that here as well. In 2019, the income was still almost 8 billion and 7.5 billion before. And then in last year, it was less because of, one, the pandemic and the litigation issues. I think that those litigation issues are almost behind them, so we should see improved cash flow going forward. If we then look at it from a fair value point of view, because what I mentioned earlier, it's important to pay the right price, not to pay too much if you want to hold the stock for 10 years. You can get it at the moment for €220, while my fair value is €253, which means that the company is approximately 15% undervalued. And this is based on the last data from the annual report. I've been calculating here with 6.6 billion, which is, I believe, really conservative at a growth rate of 6.27% and a growth rate of 3% thereafter and a multiple of 15, which I think is historically justified. What is important to know that it's currently trading slightly below that multiple. And, so there's some multiple expansion expectation on my side, which might happen. But look, I think this is such a company that should allow you to sleep well at night, and it's currently giving you an almost 5% yield. So this is, in my opinion, the second company after Texas Instruments. Now let's go to the third company, and that is T. Rowe Price Group. I discussed this company not too long ago, and I did more like a deep dive in there, and I will put the link to that video in the description below. I think this one has again a really safe dividend. T. Rowe Price Group is an actively managed fund manager that creates a lot of indexes and sells them to their customers. Their customers are often actually institutional investors like pension funds and other wealth management, companies. It has a credit rating of A+, a debt to equity of 2.76. You can effectively say it has no debt at all almost. Similar to Microsoft, I would say, the balance sheet here. And the interest coverage of 100, which you shouldn't look at, it's a bit fake, because if it doesn't pay interest, I don't know what to put there, and I wanted to score the full points. It has also a dividend growth track record of 36 years, and I think this is really important here, what I'm saying, because this is a company that is really on a single metric most affected by the assets under management. What does this mean? This is the money that people are putting into their indexes, into their ETFs. You can expect during a stock market that people are pulling out the money, and that means it will have a direct profit impact to the bottom line because the company earns a fee based on the ETFs. So less ETFs sold means less profit. This happened. We saw a really severe crash in 2000 to 2002 with the dot-com bubble that bursted. It didn't cut the dividend, it grew the dividend. We saw the same in 2008, 2009 when it was in the middle of the blast zone of the financial industry. It grew the dividend, and also during the pandemic initially, the stock market crashed, it grew the dividend. What is important to know here is that the stock price crashed as well. But we're not talking here about stock prices, we're talking about dividend growth. That's what we want to see. We should, after buying initially the company at the right price, we shouldn't care so much about the price anymore, and we should sleep well at night. And with a 70% dividend growth over the last 5 years, I am definitely sleeping well at night here. Also when looking at the payout ratios, which are really low. This tells me that T. Rowe Price understands the risks that they have being exposed to the stock market, and that they are well positioned themselves for weathering any storm that might be ahead of us. Maybe the headlines will be right this time. I don't know. I have seen those headlines already for 5 years. If we look at this company, I can just tell you that everything is on green here. And this is something you don't see a lot. I believe that the fair value is around $172. That means that the stock is currently 30% undervalued. I'm using here a net income of 2.2 billion. And you can see this is really conservative because the last time it had that was in 2019. And if I then think about that baseline and the growth of 7% in the first 5 years and 4% thereafter, we'll probably need to do like 5-6 years to get to the 3 billion that we saw in the last year at a multiple of 15, which is currently at 11. So this would mean a multiple expansion like we saw with Allianz. I believe it's really not that awkward to expect this company to trade at $172. But what you do get in return for this low price is a 3.5% dividend yield. So I initiated a position in T. Rowe Price Group 2 weeks ago, and I intend to buy more with my monthly income in May because I believe it's one of those attractively valued stocks right now in the stock market. So what I've shown you now is that with all this noise, and you might be afraid of a stock market crash, that there are still enough opportunities for dollar cost averaging. You get a good yield on cost with all three of them. Maybe with Texas Instruments you have the lowest. And you should be able to compound for the decade to come without facing any dividend cuts. Of course, I don't have a glass ball. It might happen. But based on my homework, I'm quite confident that it shouldn't happen. But okay, disclaimer here, I'm not a financial professional, of course, so who knows. Now, 3 things still to know here. Texas Instruments is announcing their earnings on the 26th, that is Tuesday. So you don't need to be a hero. You can also just wait for the earnings and buy afterwards if you still find it attractive. The same is for T. Rowe Price Groups. It is reporting their earnings on Thursday, the 28th of April. And then Allianz, you can wait a little bit longer. It reports their earnings on 12th May. However, if you want to still capture their dividend, which is €10.60 or something like that, you need to buy it before the 5th of May because that is their ex-dividend date. So having said that, 3 stocks here, they should allow you to sleep well at night. 3 strong dividend growth investment stocks. And this is where I want to leave you at. Thank you for watching all the way until the end. Have a great weekend and see you next time.